everyone. A very good evening to everyone. I hope you all are fine and doing well. So, in today's class, we are going to cover all the important topics in operational risk and integrated risk management. I hope you all are fine and doing well. Also, my screen is visible to all. I am audible to all. Everything is fine from my side. So, let's start with the class. Before starting, let's learn the operational risk management means. What is the meaning of operational risk? Sorry, only risk. Operational risk here. If we talk about the operational risk, this is the risk when there are internal failure is there in the banks. When the loss occurs due to the internal failures in the banks. Now these internal failure can be people error, due to people error, due to fraud, like fraud in internal fraud done by the employees, theft done by the employees, and also some type of people error and fraud, technological problems. Okay, technological problems and external events, due to the external events like the situations which are beyond control, that are, we can say, the operational risk. Okay, and these risk basically one of the dangerous risk for the banks. Okay, and integrated risk management means when all the other risks are integrated and a proper management is there for these risks. So operational risk, this is a type of risk organizations faces, and the more complex an organization is, the more it is exposed to the risk. It happens when something goes wrong in the normal functioning of a business, like problems with the system, procedures, technology, or human mistakes. When things go wrong, the company can face extra cost or miss out any potential opportunities that could have been profitable. So that is the operational risk. Now, if we classify these risks can be classified that this risk is existing in all the overall every part of the organization. It varies in different forms. Some risk causes small damage, but these operational risk are those risk which causes a huge damage. Okay, also high severity is there, low frequency risk is there, which are particularly dangerous. Even though they are happen rarely, they can be very harmful, even very fatal to the organization. And these are the risks that are changes over the time, especially when organization is going through a lot of changes. So you can see, if I talk about the operational risk, these risk is one of the dangerous risk. They are beyond control. They can't be controlled easily. These are the risk which affects the organization's every part, and also some of the things are done by the peoples that are available in the banks that affect other banks too. So if in February 2003 there is a Basel Committee on Banking Supervision which introduced a set of principles, which are these principles or these guidelines are here just to manage the operational risk. And these principles were designed to provide a framework for effective management and supervision of operational risk. Okay, supervisory authorities and bank could use these principles to evaluate their operational risk management policies and the practices. Then Some of the principles are there of operational risk management. As you can see, first principle is saying here what? Board of directors, they are responsible for creating a strong risk management culture. They have to, like, board of directors responsible for managing for this operational risk. Board and senior management have to promote a culture which is focused on a good management. Okay. And also we can say this is the culture which encourages all the professionals, and they are responsible, they are very clear with all the guidelines which are set it by the board of directors, and according to the guidelines of according to the standards of RBI. Then principle 2 is saying, now banks have to maintain a framework that is basically for managing the operational risk, that is fully integrated, means they have to set all the clear frameworks, they have to manage the things for smooth operations. Then board of directors, they are completely responsible for clearing, approving, making the new policies and all the new procedures related to the operation risk management. They have to regularly review all the things related to the operational risk management framework. Principle 4, they are responsible also for approving the risk appetite and tolerance statement. Now what is this risk appetite? Risk appetite, just a minute, sorry. Risk appetite is here for like risk appetite, what we can say, willingness of a bank, that how much risk a bank can take, that we can say that is risk appetite, and tolerance statement is same. Senior management, now they all are set to create a clear and strong governance structure. They have to like they have to like uh, do all the things which are approved by the board of directors. These structures should have well defined, transparent and consistent responsibilities. Okay. And also this management is responsible for ensuring the policies, processes and the systems for managing the operational risk, and consistently they are followed throughout the organization. And principle 6 is saying here, like senior management, they have to make sure that all operational risks are identified, assessed and in all the important products, activities, processes and the systems. Principle 7 is all about that there is the approval process, a complete approval process for the new products, for the new activities, for the new processes and for the system that carefully evaluates the operational risk. Principle 8, senior management have to regularly monitor the bank operational risk profile, and any major risk of loss is there, they have to review the things. Okay, they have to put in a place to regularly monitor the bank operational risk profile. Then bank should have a strong control environment that uses the policies, processes and the systems and internal controls to manage the operational risk. Then principle 10, banks have to plan in place to ensure the business continuity. Principle 11 is what saying, principle 10 is like everything is in continuous basis, and banks continue their operations and all the limit losses. Principle 11 is also saying that public disclosures are very important, so everything will be transparent to for the stakeholders and for the investors, So they can understand what is the financial health of the bank, what is the actual health of the bank, and how bank are able to managing the operational risk. That is what principle 11 is saying. Okay. Then board of directors are completely responsible for what? For overseeing all the management and in implementation of the operational risk framework. They have to approve the framework and they have to review it regularly. They have to define what operational risk mean for the bank and how severe consequences are there if that operational risk is not managed properly. So board of director is a top authority of the management, and they are completely responsible for the management and for the implementation of the operational risk framework. Okay. So basically, board of director other works also, like they have to create all the policies, procedures, and they have to implement. They have to like review all the things related to the operational management. Clear? Then there is our committee, that is operational risk management committee. Like in every risk there are four departments, and same in the operational risk there are four departments. First one is operation board of directors, then operational risk management committee, who are responsible that where the operational risk arises in the banks and how they are faces the operational risk. All the policies, all the procedures are there for managing these risks. Are the things done according to these guidelines? Our guidelines are there for assessing that how severe the risk is, and also proper control actions are there for like which helps in reducing these risk, the effect of these risk, this risk. Then there is a operational risk management department, ORMD, very main department because it helps in identification, it management, and in also measuring the operational risk. It works with other groups to create the procedures that how to manage the risk. And this is the department that identify and assess the risk in all the major activities, processes, and the systems. And before new products or processes are introduced, the department ensures that a risk are properly assessed. Okay. Then what is the role of internal audit and business functions? See, roles and responsibilities of internal audit and business function, that they have to check that everything is going clearly. Is the is the basically what uh, everything is clearly defined to the management. This internal audit function check the effectiveness of the operational risk management framework. Then operational risk quantification, measuring the risk is very important in when we are going to mitigate this risk. So the behavior of operational risk basically does not follow a normal statistical pattern, which is very due to which it is very hard to predict what will happen in the future. Okay. Basic indicator approach is also a method which is used by the banks to determine how much capital banks need to set aside for the operational risk. But according to the approach, banks have to keep 15% of the uh, average gross income over the past 3 years. Okay. BEICF, this is a key part of the AMA framework, and basically in this they they analyzes that how strong the internal controls are, and this ORMF are involved in creating and monitoring the tools which are evaluating the business environment internal control factors. And RCSA is a risk and control self-assessment where bank evaluates its own operations and the activities to identify where the actual weaknesses available in the banks, and how they can give their best in handling all the operational risk. And this process basically done internal done at the internal level. Okay. And lots of workshops are there, lots of training sessions are there to uh, identifying that what is the actual strength and weaknesses in the bank operations are there. Okay, so every possible measures are taken by the banks to identify these types of risk, and in this we can say this is risk and control self assessment. KRIs, they are actually used to measure the actual levels of risk in a bank operations. This help in tracking the cause of risk, how often they are happening, and what the consequences might be there. Integrated risk management, I can tell you in short. Integrated risk management, basically when all the types of risk are integrated of all the entire organization, which includes all the risk: liquidity risk, interest rate risk, market risk, credit risk, operational risk. These risks are there just for losses, just for the losses of the bank, that can basically affect the bank's revenue. And just like profit or losses, these are the results of the different activities in an organization, and the total risk are here are the outcome of all the risk connected to the bank's activities. So what we can do in this total risk, that is basically add up the same way that profit or losses do, because risk can offset each other. And why this has happened? This has happened due to the diversification in which we can share the things, where different risk balances each other out, or the way various types of risk are here interact each other. So there is the concept that is integrated risk management. So in the operational risk, okay, so if I tell you the summary of this, in the operational risk, what we study, when what is this risk? When the risk happens, when the risk occurs due to the internal error, due to the internal error, and that internal can be due to the people, sorry, that some technological failures, and also some external events which are not in control of the banks. Okay, one of the dangerous risk, and some of the mitigations strategies are there. For basically board of directors plays important role. Then we can say operational risk management committee is there, like risk management committee. Four departments are there who are dealing with the like creating and reviewing the policies. Then some mitigation strategies which are very important. And RCSA is an important topic in which self like identification of the risk is important, own internal process is important. And this can be done due to the fraud, like if employees do the fraud with the bank, or any type of attack is there. So this is one of the dangerous risk for the banks. So that is it in operational risk. I hope that everything is okay in this, everything is clear. So thank you for attending this session. If any problem is there, you can tell me in the comment section. We will meet in our next class for some new with some new concept. Till then,